This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We begin by looking at what's meant by the term organisation. And this is a commonly used definition which we have here. An organisation is a social arrangement which pursues collective goals, which controls its own performance, and which has a boundary separating it from its environment. Now let's look at some of these terms within this definition. First of all, we have here that it is a social arrangement, because organizations are composed of people, and people are social beings. We have our own wishes, ambitions, our likes, our dislikes. We like to converse with people, we have views on people and so on. And this definition is actually fairly modern because it does recognize the social nature of organizations. They're not like machines. They are composed of people. And early management theory, as we'll see, tended to leave out the idea, or did not recognize that people were social beings with ambitions and feelings, if you like. And regarded managing people as trying to switch on machines, and if you wanted them to work harder, you simply told them to work harder, irrespective of how they almost physically might be feeling about that or what they might be capable of. Pursuing collective goals. And we'll see very shortly different sorts of organizations. Some of them are profit-seeking, where the collective goal there is really to make profits. Some other organizations are not profit-seeking. So, for example, state-run health services do not pursue the goal of profit, but they do pursue goals like curing people or research or reducing pain and so on. They should be controlling their own performance. There should be some sort of measurement and feedback mechanism, really. And if the organization is not hitting the goals that it wants to get, then some sort of action has to be taken. The performance required might be imposed from outside, but generally speaking, unless something goes terribly wrong, the organization will control its own performance. So managers are responsible for hitting sales targets. If they repeatedly don't hit sales targets and no profits are made, then the shareholders, which are kind of slightly outside the organization, may of course take action and replace those managers. And there is a boundary separating the organization from its environment. There is a feeling of us and them. We are part of the organization, they are not part of the organization. The next slide looks a little bit more at this business of boundaries and environments and so on. And what we're talking about here is some terminology which can be known as systems terminology. You have the organization itself. Let's say it's a company, a profit-seeking company. It's separated from its environment, so the environment is everything not of the company. So environment can be the government, it can be the local population, it can be suppliers, it can be customers. Those are all part of the environment. And there is a boundary around this organization, separating it from the environment, this feeling of what is part of the organization and what isn't part of the organization. In general, organizations take input. It could be raw materials. They do something with that input. For example, they manufacture finished goods from the raw materials, and then they send it out to the next stage, which could be customers, it could be a company which goes and incorporates the components into the finished product. It doesn't have to be physical inputs and outputs. It could be inputting information. For example, an accountancy firm will be inputting information from its clients. It will be producing the period-end accounts, and the production there is the set of financial statements coming out at the end of the year. Now what we've drawn on here is what is called an open system. And all that's really meant by an open system is that there is some interaction with the environment. There are goods or information or energy going into the organization, and there is processed information or processed products coming out of the organization. And nearly all organizations are going to be what's called open organizations, because if they were closed organizations, then the other alternative, a closed organization implies it doesn't take anything from the environment, doesn't put anything out to the environment. So it immediately raises the question, well, what's it for? How does it sustain itself? What is it doing? Can it just be completely cut off from the environment? And by and large, the answer is no, it can't be. Certainly not in the long term. Maybe in the short term it could be, but not in the long term. For example, if you have an organization, let's say it was a mine, and it owns the mine, it owns the ground and so on, so that the ground that the mine is on or in is part of the organization, is one of its non-current assets. It's mining something, it would presumably have to sell it. But even if it's mining metal and makes metallic objects and so on, it doesn't know what to make, actually, unless it had information coming in about what its customers might want or what its competitors might be doing. So closed organizations are a kind of theoretical concept. They have no long-term really chance of survival. So it's a theoretical peculiarity, really. The other main thing about organizations is that they can usually be broken down into what are called subunits. So this could be our company, and here we have the purchasing department, and then maybe we have the manufacturing department, and then we have the sales department, and maybe we have the accounting department. And each one of these subunits is itself a little system, or subsystems, if you want to call it that. Each subsystem is a little system. Each of these subsystems has got its own boundary. The manufacturing part, the factory part, if you like, is separate from the sales part, is separate from the accounting part, and so on. And they basically, goods will be coming in here, raw materials to manufacturing, to purchasing rather, to stores. They will then be output from stores and input to manufacturing. And then it will be output from manufacturing and on to the sales department or the warehouse, and then go from the sales out to the customers. Now, does that matter? To some extent, it almost seems trite. And I think the main element of dividing stuff into subsystems is the boundary. We have to know what is ours, what is us, and what is you. For example, who should be keeping track of raw material inventory? Should it be the purchasing department? Should they be the people who decide when something is going to be should be ordered? Or is it the manufacturing department who knows what it has to manufacture? It knows what's to be done next week. Should it be the subsystem which sends orders out to suppliers? And actually it doesn't much matter. But the important thing is they know whose responsibility that is. Which subsystem is responsible for determining what inventory is needed and ordering it. What we don't want is any gaps. What we don't want is any overlaps within the two subsystems. Types of organization. This is quite important. Commercial or profit-seeking organizations are very common, and there are various sorts of them. There are sole traders, and a sole trader is just someone starting up themselves and beginning to trade. Key elements about sole traders is a very quick to set up. There's very little bureaucracy required. The downside is that there is really no distinction between assets owned by the business and assets owned by the individual, the sole trader. And this means that if the business goes bankrupt, then the creditors, the people who are after their money, if the business can't pay them, they can pursue the business owner. Because really it's just the business owner who's trading themselves. There's no separation, if you like. There may be for accounting purposes, but not for legal purposes. There's no separation between the owner and the business. Many businesses start like this because it's so quick and easy. Partnerships are where two or more people trade together with a view to profit. They put in capital according to some agreement. They will share profits according to some agreement. The key thing about partnerships is that ordinary partnerships, again, do not enjoy limited liability. If the partnership goes bankrupt, then each of the partners can be pursued for the debts of the partnership. Partnership tends to be a much more comfortable arrangement, maybe, than sole traders. Sole trader can be quite a lonely existence. What happens if you're ill? How do you get holidays? Who's going to be looking after the business? Who's going to be taking responsibility for it? Who are you going to talk to if you have a problem? With partnerships, let's say 4 partners, they can organize holidays, they can cover for each other if there's illness. And one of the great benefits of a partnership is you can talk through problems and difficulties with your partners. Limited liability partnerships is a relatively new organizational type. It was brought in because it was recognized that maybe large companies like firms of lawyers or firms of accountants, which were traditionally partnerships, had to be partnerships. If something went wrong with a law case or wrong with an audit, there was a huge amount of compensation to pay, and it could actually bankrupt the partners. A lot of risk involved in that. So limited liability partnerships were invented, if you like. They work like a partnership, but the great thing is that if the partnership goes into liquidation, if it fails, then the creditors can look for assets that the partnership owns, but it can't go after the savings in the house and so on of the various partners. Limited companies or corporations, one of the commonest forms of business organizations. They are limited, meaning that the shareholders have limited liability. So the way these are started up, they take a little bit of legal work. You have to register a company to bring it into existence. And then you have shareholders. The shareholders and the shareholding really measures your share of the company. They put in money and they get shares in exchange. And the company trades. And then if the companies make some profits, the shareholders can get dividends. So the money going in goes into shares. And then if any money is paid out, it'll go out as dividends. The great thing about shares is that they can be bought and sold. You can easily find more shareholders. You issue some more shares to them. The shares can be inherited. They can be gifted. There's all sorts of quite good things. In many ways, companies have a permanent existence. Shareholders can come and go, but the company kind of carries on. Where you have to be careful is this word limited company. If a company goes bust, its liability is unlimited. Every asset, every dollar of the company can be grabbed by creditors. What is limited in a limited liability company is a liability of the shareholders. What they stand to lose is their shareholding. But again, the creditors cannot follow the shareholders for the shareholders' personal assets. Most limited companies are profit-seeking. Then we have not-for-profit organizations. Not-for-profit organizations, for example, a charity. So a charity, it collects money, it pays it out, it's not there to be making a profit and so on. They can be limited companies. They don't have to be limited companies. The main difference between that and a commercial organisation is its purpose, its thrust, if you like. So charities, some government sort of organisations are in there as well. Public sector. Public sector organisations owned by governments, either national governments or local governments. Public sector organisations are usually not profit-seeking, but do not have to be. For example, in the UK, 25, 30 years ago, British Airways was a public sector company. It was still a commercial company. Its aim was to make profits. It rarely did, but nevertheless it was a profit-seeking organisation. Nowadays, the fashion is really for governments not to hold businesses. The feeling is government should only run organisations where only governments can run them, like defence, for example, or maybe the National Road Network, something of that sort. In some countries, the health service, and should allow private organisations, commercial organisations, to run all the other types of activity. So don't get mixed up. This is a common source of confusion. Public sector can be commercial or can be not for profit. Okay. Most are not for profit, but not exclusively. We have non-governmental organisations. These tend to be not-for-profit organisations. They're very like ordinary not-for-profit organisations, but there's some legal differences. Strictly, they're not charities. If something's going to be a charity in the UK, it has to go through certain registrations and so on. But these are very often international sorts of organisations. And finally, you have cooperatives, where there's a kind of mutual interest. A band of people will join together to pursue maybe a manufacturing type of process. They all contribute to the manufacturing. They share the profits, share the output, and so on. These are mutual organisations, not that common. They tend to be quite small. You can come across a little cooperatives, say, for buying food. So maybe just a group of neighbours joins together as a cooperative, maybe to source organic food. So they can put in big orders, they get good discounts, and then of course they can split up the food when it is received. They can be profit-seeking, they might be non-profit-seeking. It's really the nature of the ownership and the kind of mutuality, really, of the relationship. They're not that common. Organisational structures. Well, organisational structures start off as entrepreneurial. Basically, an entrepreneurial structure is basically you have the boss and you have the workers. And the boss is definitely the boss. Yeah, everyone knows who the boss is. There's no kind of middle management. The boss wants to keep his or her finger kind of on everything. Not very much discussion with people as to what to do. The boss knows best sort of thing. This is what's seen typically in small new organisations. Only the one person maybe starting it off, one person, one employee perhaps, and no real structure to it, but it begins to grow. And as it begins to grow, then it becomes a functional structure, which we'll see. But basically, it begins to divide into departments: a sales department, a purchase department, an accounting department, a research and development department. In other words, you're organising organisation by the function carried out by the different departments. And this is almost essential because as a business grows, one person can't be master of everything, cannot keep an eye on the purchases, the production, the research and development, the sales and so on. It's just too much work. And it will evolve into a functional structure. Divisional, we'll see, is another really step in evolution. Now we're really big, and now maybe what we have is our North American division and a European division. And we'll see that in a moment. A matrix structure is very often used in project management. I am to do with quality control, but I have been assigned to this project for 6 months. I've almost got two bosses. I have to report to my quality control manager for all the quality control tests I'm carrying out, but I have to kind of be reporting to my project manager to make sure everything's been carried out properly and we're going to hit the deadlines and so on. And then we have relatively new types of organization, less formal types of organization, boundaryless as they're called, and we'll see what's meant by virtual, hollow and modular. Here's a typical functional structure. Managing director at the top, and then we have the finance department, the manufacturing department, the research and development, the sales department. Great efficiencies here, a lot of economies of scale. All the finance matters, all the accounting matters goes through there. They get very good at it, very practiced at it. They're kept kind of busy. You can have one well-qualified accountant at the top. You have a team of people, all from the same background and so on, all speaking the same language. Over on sales, again, they can become very specialist, a good sales director at the top. And again, people who are specialists in sales. And one of the great things about the functional structure is its efficiency, but also getting back to the idea of a social organization. People tend to like socializing with people who are similar. So the sales team all gets on quite well together. Similar experiences, similar personalities perhaps. Similarly, the finance team all kind of get on quite well together. Similar educational qualification backgrounds and so on. Similar interests, if you like, in precisely recording transactions and the like. And this is almost universal once we just get beyond the entrepreneurial stage. Are there any difficulties with it? And the main difficulties come when it gets really big. And the first one is, let's say you're really big and your manufacturing manager was responsible for staff of 2,000. Now, if you are a manager or a director responsible for a staff of 2,000, you are an important person. This is a lot of responsibility here. And to some extent, this can kind of go to your head a little bit. So you can imagine a kind of scenario where the sales manager thinks they've got a new customer, but the new customer wants something done very quickly as a kind of trial order. So the sales manager goes over to the manufacturing director and says, I know you're in the middle of a big production run, but could you interrupt it and just make these 100 units for this potential new customer? Because if we really please them, then we're probably going to get lots and lots more orders. And the manufacturing director thinks, well, if I stop the production line, I'm going to have inefficiencies. It's going to be hassle to me. I'm going to have to explain why we didn't make as many units as we thought. And this very powerful manufacturing director simply says, no, I won't do that. I won't cooperate. So what you tend to get, people nowadays call it silos. People kind of live in their own little kind of kingdoms almost within the empire. And they become almost uncooperative with other parts of it. The second reason, again, it's to do with things getting larger, is that as organizations grow, they inevitably diversify a little bit. they are going to be making goods for North America, Europe and Asia. And the goods are going to be slightly different. And the competition in those three markets is going to be slightly different. They may extend their products. So one of our big chemical companies, it had two main products. It made paint, household, commercial paint and so on. And it made agricultural chemicals. And those again were entirely different manufacturing processes, entirely different markets, entirely different competitors. And there isn't much point really in trying to kind of jam them together in one sales department, one manufacturing department and so on. And the next kind of evolution, we'll come back to that in a moment, is the divisional structure. And here what we say is we're going to have maybe the North American division and the European division. So it can be done on the basis of geography. Or what we might have is the paint division and the agricultural chemicals division. So it could be product. And the third way in which you might divisionalize a company is really on the basis of customer. So maybe Division A sells to consumers, members of the public, and Division B sells to other businesses. Because again, selling to members of the public needs a whole lot of different marketing and packaging and advertising. Maybe needs slightly different products to what you're going to be selling to other organizations. The method of selling is going to be very different. Maybe the products need to be stronger because they're going to be used very intensely in other businesses. So divisionalization is really the way almost all large organizations go. And basically you're getting specialization. The sales department here knows how to sell in America. It knows the competition, it knows the pricing, it knows what adverts work. A sales department here is going to be selling in Europe. It knows how to sell in Europe. It gets to know the big buyers in Europe and so on. Manufacturing in the American division knows the legal requirements, the safety requirements perhaps, to allow something to be sold in America, whereas the European division knows the safety requirements and regulations governing manufacturing in Europe. Very common. You lose a little bit. You don't get economies of scale. We now have maybe 2 accounting departments, 2 research and development departments, and so on. Perhaps, obviously, there can be slightly other patterns in here, but this specialization more than wins out. Finally, in this, we'll just go back to a slide here. The main functions that you can have in a functional arrangement. Research and development. Very important. It speaks for itself. Purchasing usually is saying what we're going to purchase, who we're going to purchase it from, when do we purchase it, how much do we need, and negotiating prices, sending out the orders, counting the goods, inspecting the goods when they come in, and so on. Perhaps storing the goods in inventory until they're needed. Production will take goods from inventory. It will make stuff. And it will make stuff either according to some pre-programmed plan, like next month we're going to make 2,000 units, or in more modern organizations, production will make products only when they're ordered, what's called a just-in-time arrangement, just-in-time. So rather than the manufacturing department or production department just kind of churning out stuff that may just stack up in inventory, they only make stuff to order. And obviously, if you're going to do that, you have to be pretty slick about it. You have to be pretty good at turning stuff around quickly so that the customer can get the product quickly. Direct service provision, an example would be IT. The IT department tends to be giving services to accounting, to production, to research and development and so on, a kind of shared service. You can put accounting in there if you like, because the accounting department also can spreads itself, providing services right across the organization. Marketing Marketing, we'll see, has to be separated from sales. Marketing is really finding new customers and designing products that suit those new customers. Sales is encouraging people to buy the products. They're often banded together. We talk about the sales and marketing department, but marketing is supposed to be a very open kind of process. What do our customers want? How can we produce goods or services that will suit those customers? And if you do that, then the sales department will have an easy job. If marketing doesn't work very well, and you produce goods which are unsuitable or unfashionable or wrong price or something, then sales is going to have a heck of a job pushing these goods to the customers because they're not really what the customers want. Admin, lots of admin, for example, human resources, recording people's qualifications and so on. Maintenance can be in there, or maintenance can be direct service provision and so on. And then finance, maybe finance and accounting. Finance has to look after raising more capital, talking to the bank manager to see what overdrafts might be needed, planning when tax has to be paid, and so on, looking at the cash flows, making sure the wages and salaries are paid on time, and the like.